The birth of Invest in What You Know. Peter Lynch is a name that echoes like a legend on Wall Street, a figure who transformed the world of investing not through complex formulas or elite secrets, but by championing the power of ordinary knowledge. For Lynch, the stock market wasn't a mysterious machine controlled by the financial elite. It was a living, breathing ecosystem of everyday businesses, places where people shopped, dined, worked, and interacted constantly. He believed the greatest advantage in investing didn't come from Wall Street, it came from Main Street. Between 1977 and 1990, as the manager of the Magellan Fund at Fidelity Investments, Lynch delivered what many consider the greatest performance in mutual fund history, an average annual return of 29.2%, turning a $20 million fund into more than $14 billion. Nothing about that success was accidental. Behind it stood a philosophy: invest in what you know. But to understand the power of this idea, we must first understand Lynch himself, how he observed the world, how he learned from life long before he learned from financial textbooks, and how he developed a strategy that empowered millions of everyday investors to take control of their financial future. Lynch did not grow up wealthy. At the age of 10, his father passed away, forcing his mother to work to support the family. Young Peter took odd jobs to help out, one of them being a golf caddy at a prestigious country club. There, he overheard investment conversations between business executives and wealthy patrons. That unlikely environment became his classroom. He listened. He asked questions. He saw that investing wasn't just numbers, it was people making decisions based on businesses they understood. That early exposure shaped his worldview. Finance didn't have to be intimidating. Ordinary people could participate. Later, Lynch attended Boston College, and then Harvard Business School, but he never believed academic prestige alone produced great investors. In fact, he often joked that professional economists have predicted 9 of the last 5 recessions, highlighting how flawed expert opinions can be. What mattered most to him was curiosity, the ability to observe daily life and recognize investment opportunities where others saw nothing. Lynch's approach rejected the idea that only analysts with deep access to corporate data could identify great stocks. Instead, he encouraged investors to look around their own lives. Which stores always have long lines? Which brands are your kids begging for? Which products are improving rapidly in quality? Everyday experience, he believed, gives everyday investors the first-mover advantage, spotting trends before Wall Street analysts arrive. One of his most famous examples was Legs, the company that sold women's pantyhose in grocery stores. Lynch noticed his wife buying them frequently because they were easier to access than traditional department stores. That simple observation led to a high-return investment, because he understood it as a consumer, not as a financial professional. Another iconic example was Dunkin' Donuts. As a Boston local, Lynch knew how popular the brand was, long before the company expanded nationwide. His guiding philosophy was simple but revolutionary: if you love the product, and everyone else around you loves the product, there might be something worth researching. This wasn't blind optimism, it was the starting point. Because while the average person may notice great businesses first, Lynch insisted that true success requires research, lots of research. Invest in what you know does not mean investing solely based on intuition. It means intuition should spark investigation. Lynch famously spent evenings reading annual reports, analyzing company financials, and speaking directly with management teams. He believed that every stock tells a story, and the investor's job is to figure out whether that story has a happy ending. At the core of his strategy was a deep respect for fundamental analysis. A good business had 3 features: strong earnings growth, manageable debt, and a clear competitive advantage. But Lynch didn't stop at analyzing companies, he also analyzed himself. He categorized investors into 6 personality-based groups, warning that unsuccessful investors were those who lacked self-awareness or emotional control. His message was blunt: know what you own, and know why you own it. If you cannot explain a company in simple language, as if telling a story, you have no business owning the stock. Lynch's greatest strength wasn't just stock picking, it was discipline. He controlled his emotions during market chaos. While others panicked, he saw opportunity. During downturns, he didn't ask, "How low will it go?" He asked, "Is the story still intact?" If yes, he bought more. Lynch embraced volatility as a gift. The market's irrational behavior allows rational investors to profit. And yet, he openly admitted his mistakes, many of them. Out of hundreds of stocks he bought, only a handful drove the majority of his returns. That experience fueled his belief in 10-baggers, stocks that increase 10 times in value. Finding a 10-bagger changes your life. You only need a few. But to find them, you must be willing to look where others are not, early, small companies hidden in plain sight. This is where everyday investors have a real edge. Because they see products before Wall Street spotlight shines on them. Lynch said, "The person buying the product knows more about it than the analyst covering the stock." This democratized model of investing inspired millions. He didn't build a strategy that required genius. He built one that required awareness, curiosity, and patience. Peter Lynch became a champion for the individual investor, not by simplifying the market, but by empowering people to believe they already had the tools required to succeed. And at the heart of his philosophy was one liberating truth: you don't need to beat every investor. You only need to beat yourself, the fearful, impatient version of you. This is where the story of Peter Lynch truly begins, not in the formality of finance, but in the everyday world where ideas are born. In Part 2, we will dive deeper into how Lynch executed this philosophy in the real world, how he evaluated companies, managed winners and losers, and built one of the most successful investment track records in history. But first, remember this: sometimes, the best investment insight isn't found on a spreadsheet, it's found in your shopping cart. Peter Lynch's legendary career wasn't simply defined by numbers, it was defined by a mindset. A philosophy built on observation, curiosity, and simplicity. While many Wall Street professionals drowned their strategies in complicated formulas, Lynch believed that the everyday investor had a unique upper hand. They lived in the real world. They saw trends long before analysts wrote reports. They talked to consumers long before hedge funds noticed sales. They recognized innovation not from spreadsheets, but from experience. Lynch called this advantage investing in what you know, and it became the core thesis behind some of the greatest investment decisions of the 20th century. One of Lynch's most cited examples is his investment in Hanes, the company behind the popular Legs pantyhose brand. Lynch didn't find this investment by studying obscure market signals. He noticed how quickly the product was becoming a hit among women who purchased them in grocery stores. That simple observation, paired with solid financial research, led to a major win for the Magellan Fund. To him, this was the perfect illustration of a timeless truth: if you pay attention, the market speaks. Everyday life becomes a goldmine of opportunities. But Lynch also knew that simplicity didn't excuse ignorance. Invest in what you know wasn't a command to invest blindly, it was an invitation to dig deeper. The research didn't stop at a product you liked. It started there. He famously said, "The person who turns over the most rocks wins the game." Understanding a company meant understanding the story behind the business, what drove its growth, what expanded its market, and what protected its future. Lynch used a tool he called the 2-minute drill. If an investor couldn't explain why they owned a stock within 2 minutes, clearly, logically, and with conviction, they shouldn't own it. This philosophy forced discipline. It transformed curiosity into knowledge. And it separated true investors from emotional gamblers. While many traders chased quick gains, Lynch understood that wealth comes from patient ownership of good companies. He consistently reminded investors that the stock market is not a casino unless you make it one. He believed strongly in the concept of 10-baggers, stocks that could grow tenfold from the purchase price. These were the hidden treasures of the market, and finding them required thinking long-term. 10-baggers didn't appear overnight, they needed time to grow, time for innovation to scale, and time for the market to finally recognize their value. Lynch's strategy highlighted another critical lesson: the importance of understanding industry cycles. He categorized companies into different groups: stalwarts, fast growers, slow growers, cyclicals, turnarounds, and asset plays. This classification gave investors perspective. A fast-growing tech startup required different expectations than a slow-moving utility company. A struggling retailer might be a disaster, or a turnaround miracle. Without knowing your company type, you couldn't know your future returns. Lynch also warned against diversification, buying more companies just to appear diversified, even when you didn't truly understand them. It wasn't the number of stocks that created safety, it was the understanding behind them. Better to own 5 companies you fully researched than 50 you knew nothing about. One of his strongest beliefs was that market volatility shouldn't scare great investors, it was an opportunity machine. When stock prices dropped without real business issues behind them, Lynch saw something exciting: a sale. He often said, "Everyone has the brainpower to make money in the stock market. Not everyone has the stomach." Emotional control became a central pillar of his philosophy. Because fear and impatience might be the biggest destroyers of wealth ever known. Lynch's public communication style also made him unique. While other fund managers hid behind jargon, Lynch spoke to everyday people in relatable language. He wrote books not to show off his brilliance, but to democratize financial understanding. He believed anyone willing to do the work could succeed. That belief wasn't theoretical. Under Lynch, Magellan grew from $20 million to more than $14 billion, yet he still preached simplicity. Even after beating the market for 13 straight years, he didn't claim he could predict where the market would go next month or next year. Instead, he reminded investors that the true engine behind returns was the performance of the companies themselves. Stock prices were noisy. Earnings growth was truth. Lynch's strategy thrived in an age when technology didn't yet dominate analysis. But his principles remain more relevant than ever in today's chaotic, headline-driven investing world. In a landscape filled with algorithmic trading, crypto hype cycles, and rapid speculation, Lynch would ask the same foundational questions: do you understand the company? Do you believe in the product? Do you know what drives the business? Can you explain your investment logic without checking your phone for the latest price movement? Peter Lynch's legacy isn't that he beat the market. Many have, briefly. His legacy is that he taught millions how they could do it too, using the power they already had, their observations, their consumer insights, their everyday experience. Because investing success wasn't reserved for elite institutions. It belonged to those curious enough to look and disciplined enough to learn. His philosophy empowered ordinary people to play the game, not as spectators, but as winners. And that is why Peter Lynch remains one of the greatest investor educators in history. He proved that the individual investor, with knowledge and patience, can thrive in a world dominated by professionals. Above all, Lynch believed that behind every stock ticker was a real business. A real workforce. Real risks. Real potential. Understand that, and you unlock the greatest investment power of all, conviction. And conviction, when paired with opportunity and patience, becomes unstoppable. Peter Lynch's philosophy has stood the test of time not because it was complex, but because it was undeniably human. It grew from real life, from noticing what people buy, what companies grow, and what innovations reshape everyday habits. But to truly understand the power behind his approach, we must explore how he handled the most difficult part of investing: uncertainty. Markets rise and fall. Headlines panic investors. Economic cycles shift without warning. Lynch knew that even brilliant research couldn't eliminate volatility. However, he believed something profound: volatility is not risk. Losing conviction is risk. His approach wasn't about predicting the future with perfection, but preparing for it with knowledge. Lynch famously said, "If you're prepared, you'll do well. If you're not, you'll fail." Preparation meant owning businesses you understood so deeply that temporary price drops didn't shake you. Because when others panic, those who understand the fundamentals remain steady enough to seize opportunity. This mindset reveals why Peter Lynch was not just a stock picker, he was a storyteller. Every company he invested in had a story with catalysts, challenges, players, markets, and competitive advantages. A stock wasn't a number. It was a narrative unfolding over time. But the key was whether the investor understood the narrative clearly enough to judge whether the future could be better than the present. This is why Lynch obsessed over earnings growth. He believed that if a business grows earnings consistently, the stock price must eventually follow. Short-term fluctuations are noise, performance over years is truth. And this truth ties into what might be the greatest insight Lynch gave to the world: no one can consistently predict the market's short-term direction, so stop trying. Experts make projections, analysts release forecasts, media creates drama, but none of them control economic destiny. The only thing an investor can control is their own decision-making process, their research, their patience, and their emotional responses. Lynch encouraged individual investors not to imitate the behavior of institutions, which often cared more about short-term perceptions than long-term results. Professionals feared embarrassment. Individuals could focus on wealth. That distinction was powerful. He urged investors to avoid the trap of following crowds. When a stock became widely popular, the real opportunity had often already passed. But when pessimism peaked and prices sank, that was the moment sharp investors stepped in, so long as the company's story remained intact. Lynch wasn't afraid to be early. He wasn't afraid to be alone. But he was always afraid of being unprepared. His unmatched success came from balancing optimism with skepticism, curiosity with discipline, confidence with humility. Another central element of Lynch's legacy was education. He wanted people to believe in themselves as investors. Not by gambling, but by learning. He rejected the myth that investing is only for professionals. He reminded everyone that you don't need to be a math genius or a market insider. You only need to observe the world with open eyes and follow up with solid research. This democratization of investing changed the lives of millions. When Lynch retired in 1990, he stepped away at the peak of his career, not because he lost interest or ability, but because he valued life beyond markets. He often encouraged balance. The stock market is not your life. If it is, you have a problem. He donated time to philanthropy, supported financial literacy efforts, and continued writing to empower others. His impact far exceeded the billions he earned for investors. He shaped a new generation of stock pickers who believed they could win, if they stuck with what they truly knew. Today, decades after his retirement, the investing world has transformed, yet the core principles Lynch preached remain undeniable truths. Solid businesses create long-term wealth, knowledge and research beat speculation, opportunity often hides in plain sight, patience multiplies returns in a way timing never can. Whether it's a new technology, a retail trend, or a disruptive business model, consumers see the future before Wall Street does. That's why every investor, no matter their background, can find a competitive edge simply by being a curious observer of life. And perhaps the greatest lesson Lynch leaves us with is this: investing success doesn't require perfection, only persistence. You will be wrong sometimes. You will pick losing stocks. Even the greatest investors do. But a few winners, just a few, can change everything. A single 10-bagger can make up for dozens of failures. That is the asymmetric beauty of equity investing. When you invest in what you understand and believe, time becomes your ally. Compounding becomes your greatest partner. Wealth becomes a natural outcome, not a desperate chase. Peter Lynch didn't just show how to find winning stocks. He showed how ordinary individuals could think, observe, and invest like champions. His philosophy unlocked confidence in investors across the world, confidence grounded not in hope, but in understanding. And that is why his legacy doesn't fade with market cycles. It grows stronger. Because as long as people continue buying products, discovering trends, and living life, opportunity will always surround us. Lynch taught us to look. To question. To research. To believe in the power of simple insights backed by deep knowledge. In a world obsessed with shortcuts, he showed that true wealth belongs to those who stay curious, stay disciplined, and stay patient. And that is the timeless brilliance of Peter Lynch. He transformed investing from something feared, into something anyone can master. As we conclude this journey into Peter Lynch's philosophy, remember this: the world of investing is not reserved for a select few. It is open to every individual who is willing to observe, to learn, and to take action with patience and discipline. Wealth is not created by chasing what others hype, but by understanding what you believe has true long-term value. Peter Lynch's legacy is a reminder that the greatest investment edge might already be in our hands, in our daily experiences, in the stores we visit, in the products we love, and in the innovations changing how we live. You do not need to predict the future perfectly to succeed. You only need to recognize opportunity when it's right in front of you, and stay committed long enough to let it grow. Thank you for watching this documentary. If you found value in this content and want to continue learning how legendary investors think, make sure to subscribe to the channel. Join us as we explore more powerful strategies, timeless lessons, and the mindset behind true financial success. Stay curious. Stay patient. And keep investing in what you know.